Hello everyone, thanks for checking out my video. Volatility returned last week as investors reacted to sky-high valuations in the tech sector. The tech-heavy Nasdaq ended lower on Friday, dragged down by a sell-off in tech and AI stocks, marking its worst week since April this year. Suddenly, investors are starting to question whether the massive AI investment boom will really pay off. Adding to that, renewed concerns about an economic slowdown and a weakening job market are weighing on investor sentiment. Meanwhile, the famous big short investor Michael Burry revealed that he has taken millions of dollars of put positions against Nvidia and Palantir. That's a very bearish signal. Could he be seeing something the rest of us don't? Is this latest sell-off the start of something bigger? Let's address some of these questions in this video. And oh, I have made a new buy last week, so do stay till the end to find out which stock I picked up. The three major US indexes ended last week lower, with the Nasdaq suffering the biggest hit as it posted its worst weekly performance since early April. This came after investors got skeptical about the bullish momentum in AI and tech mega cap names. Investors are beginning to question whether the sharp AI-driven rally seen over the past several months was sustainable, especially with valuations running hot and market gains heavily concentrated in just a handful of large tech companies. AI and tech leaders were at the center of the pullback. Household names such as Nvidia, Tesla, Meta, Oracle, Palantir, and AMD lost between 5% and 13% over the last 1 week. There seems to be some profit-taking going on as traders rotated away from high-growth tech into more defensive sectors. At the same time, market volatility increased last week as US Treasury yields fluctuated. This is a reminder that uncertainty about the Federal Reserve interest rate path is still shaping market sentiment. In case you don't know, higher yields tend to pressure growth stocks, therefore amplifying the sell-off in the tech industry. On the macro side, labour market concerns added to the cautious tone. A new report from global outplacement firm Challenger showed that last month was the worst October for US layoffs since 2003, indicating rising job cuts and hiring freezes. With official employment data delayed due to the US government shutdown, investors are turning to this report as a substitute indicator of labour trends. The report also highlighted that, like in 2003, a disruptive technology is changing the landscape. Today, AI appears to be driving a similar structural and material shift. Overall, the sentiment has shifted to risk-off approach a little bit as investors balance stretched valuations, labour market uncertainty, and evolving expectations around the Fed policy. Looking ahead to the coming week, investors will be navigating a more defensive and cautious market tone. It would have been a busy week of economic data with consumers, producers, retail sales and inflation reports due, but those releases will be delayed due to the ongoing government shutdown. Therefore, investors will instead seek insight on the economy from secondary reports, including the Small Business Optimism Index due to be released on Tuesday by the National Federation of Independent Business. Meanwhile, the earnings season continues, and as always, companies' guidance may matter more than their results. The firms that are reporting this week span across tech, retail, and consumer-focused sectors, which could offer insight into how US demand and economy are holding up amid higher borrowing costs and economic uncertainty. Some of the big names include Walt Disney, Sea Limited, CoreWeave, and Cisco Systems. Overall, I would expect similar level of volatility around tech and AI leaders as we head into Nvidia's earnings the following week. Lastly, pressure surrounding the ongoing government shutdown is intensifying, which may accelerate efforts to reach a resolution. If a deal is reached, it could give the market a very short-term boost as investors see it as a reason to step in to buy the dip. Alright, let's now move over to the technical analysis portion. Last week was the first time where SPY tested the 50 moving average since April this year. Just to share, the index has been moving above this moving average for 133 sessions, the longest streak since 2007, and that almost came to an end last Friday. For the upcoming week, I think we can use this 50 moving average as a gauge of the market momentum and its next direction. If SPY starts closing below this moving average, then obviously it's bearish. In fact, it is already a little bearish considering it has fallen below that green uptrend line. So by closing below the 50 moving average, I think it could unlock more downside, probably towards the 50% Fibonacci retracement level at around 653 in the short term. If we don't have very negative news from the macro environment, I do think this 653 level should hold, as it has acted as a decent support on previous occasions. On the other hand, if it continues to bounce off the 50 moving average like what it has done last Friday, then that's positive. But for the bullish momentum to resume, it needs to get above the green trend line. By doing so, SPY would have reclaimed the 23.6 Fibonacci level at 673 as well. Let's now jump over to Apple. Apple looks like it's holding up pretty well despite a sell-off in the tech industry. There are a few things to note in the upcoming week. First of all, the MACD had a bearish cross last Friday. This means the weakness might just continue this week. If it really does, watch how deep the pullback is. If the pullback doesn't bring Apple below the green uptrend line, then I would say Apple's bullish trend is still intact. In fact, a retracement to the trend line followed by a bounce is a very positive sign. However, the moment Apple goes below the green trend line, then we need to be a little careful. Below the trend line, pay attention to the first Fibonacci retracement level at around 259. If Apple loses that, I think there is a very high probability that Apple will continue to decline towards the gap area between 253 and 255. At this gap area, you might want to watch the 50 moving average like a hawk. Apple hasn't tested this moving average since June this year. Therefore, a close below it is definitely bearish. Personally, I won't be too excited until Apple goes near the blue support line at around 241. But that said, if Apple goes below the 50 moving average in the next 1 or 2 weeks, I might consider selling put options. Moving over to Tesla. To be honest, there's nothing much to analyze for Tesla. Like what I have mentioned in my last video, Tesla is currently in a consolidation phase as it moves between 410 and 470. That being said, there's one thing worth highlighting. Sorry, before that, if you appreciate my effort and free content, you might want to consider supporting this channel through any of the following ways. I would be very grateful. Feel free to pause the video to go through the details. Okay, something that is worth highlighting is that just like a few other big tech stocks, Tesla is finally testing the 50 moving average, a support that it has not tested for months since June this year. A test of this moving average followed by a rebound is positive. When that happens, it could actually push the share price higher towards the top end of the consolidation zone again. And that's a good 30 points upside at least. So if you're a short-term trader and can ride this short-term bounce up, you should be able to get some decent profits. But of course, you will need to have a stop loss, because the moment Tesla loses the 50 moving average by closing below it, things can get dangerous. It could unlock more downside where we could see Tesla falling into the low 400s range. In fact, I wouldn't be surprised if the huge 400 level breaks and Tesla continues to fall towards the bottom of the huge gap between 396 and 402. And if the share price doesn't bounce after the gap fill, it's gonna be waterfall time. Alright, all in all, the next move out of the consolidation zone, either up or down, can be massive, and you wouldn't want to get caught at the wrong side. So perhaps the wise approach to adopt now for most investors and traders is to observe and wait for the breakout or breakdown. Moving over to Google, if Apple is considered as holding up well, then Google is even better. The share price has been moving in the 270s and 280s range throughout last week, and seemed to be undeterred by the sell-off in the big tech names like Nvidia, Meta, Microsoft and Palantir. That being said, the MACD is crossing down. Though it's still not near a bearish crossover, it is still worth paying attention to in the upcoming week. If we do have that bearish crossover, then I would expect Google to go below 270. From there, depending on how the broader market moves, but if the tech sell-off continues this week, I think there is a chance for Google to drop towards the gap area between 261 and 264. If we get a rebound after the gap fill, then it's bullish. Otherwise, then watch that 50% Fibonacci level at around 258. That was the previous breakout point, so the bulls would want to protect this level. But if Google somehow loses it, then I think we can expect to see Google touching the 250 level or even lower. Honestly, if Google can go back to the 250s range, I would be excited. On the other hand, if the bulls can keep Google above 275 where the 23.6 Fibonacci level is, then Google is actually still pretty bullish. And when the broader market recovers, Google could be the first among the big tech stocks to hit another all-time high. Next up, let's check out Meta. I guess you don't need me to tell you that among the Mag 7 stocks, Meta's price action is the weakest at the moment, and that has prompted me to sell more put options. More on this in the options trading segment. Anyway, Meta is extremely bearish because it lost both the important 250 moving averages. Not just that, it also fell below the purple downtrend channel. It has basically completed the 100% retracement, and we are back to where we were in May this year. Okay, everything looks really bad at the moment, right? Well, here are some potential positive signs. Note the word potential. It means we still need to observe further before we can determine if Meta can stop its current rot. First up, last Friday's candlestick looks like a bullish hammer to me. The unique shape of this candlestick tells us that although the price has initially dropped, buyers step in during the day to reverse the decline and push the closing price up above the opening price. This signals a potential shift from bearish to bullish momentum. Note the word potential again. Anyway, a single candlestick doesn't determine a trend. We should wait for confirmation. Basically, the next candlestick needs to close above the high of the hammer, which is 622.13. In addition, an increased volume would increase the reliability of the reversal. Okay, but on the other hand, if the hammer candlestick gets invalidated, personally, I will watch out for the psychological 600 level. If Meta starts closing below it, I do believe there is a lot of room to fall. Minimally, I think Meta would drop towards the 570s range at least. Moving on, let's have a look at Microsoft's chart, which looks the most interesting among all the stocks I covered. Why so? First of all, the bearish double top pattern seems to be playing out as Microsoft printed 9 red candlesticks out of the last 10, and in the process fell by around 10%. What makes it interesting is that it's currently sitting at a pivotal level or the neckline of the double top pattern. If this neckline breaks, I'm not trying to scare you, the downside can be massive. I think that's when we could see Microsoft back in the 470s range, and depending on the market condition, I might step in one way or another if Microsoft does fall to this range. Next up, why I said the chart is interesting is that if you look at the chart from another angle or perspective, we can also see that there is a bullish double bottom forming. So if the current level holds, or maybe let's stretch it to the 50% Fibonacci level at 489, basically if this area holds, I think Microsoft could easily bounce back above the 50 moving average. From there, if Microsoft can stay above the 50 moving average for a few days or 1 week, then that's quite positive, and before you knew it, we could be back above 523 again. Okay, last but definitely not the least, Nvidia. Nvidia printed 7 consecutive red candlesticks before we had that green one last Friday. It is basically looking bearish, especially with the MACD crossing down last week. But here's the but. Positive signs had emerged last Friday. On that day, Nvidia went below the blue support line and the 50 moving average during intraday, but bulls stepped in to reverse the price back up. More importantly, Nvidia closed the day above both support levels. That said, whether this recovery can continue or not, it remains a huge question. So here are some key levels to watch. In terms of the bullish thesis, we need Nvidia to stay above the pivotal 50% Fibonacci level at around 188, or better still, reclaim the 38.2 Fibonacci level at 193. If it can do that, then it could be on its way to recovery towards the 200s range. But on the other hand, if bears come in strong again this week and push the price below both the blue support line and the 50 moving average, please be mentally prepared that the bearish momentum will likely continue. That's when I would expect Nvidia to hit the 170s range. But personally, at this point, I won't be excited until Nvidia goes back to the 160s range. Moving on, let's check out my options trade. I have 4 trades to update this week, which you can see on the screen. Okay, I shall combine the first 2 trades together. They are both new cash secure put on Meta with a strike price of 525 and 500. The contracts were sold on 3rd and 6th November and will expire on 12th and 19th December respectively. The reason for selling these 2 put options was because Meta has fallen about 17% in less than 2 weeks and have plunged around 22% since it hit a record high of 795 in August. For context, a 20% drop by definition can be considered entering a bear territory. Alright, at this point you might wonder, since Meta is so bearish, then why did I still sell put options, which is a bullish move? Well, that's simply because share price doesn't fall in one straight line. Yes, Meta's momentum is indeed very bearish now, but with the RSI floating at the oversold level, a short-term technical rebound or some sideways consolidation could happen anytime. And even if the share price dips further, as long as it doesn't drop too sharply before my options expiration dates, my put contracts should still end up profitable. That said, I need to caveat that selling put options into massive weakness is a risky move, so please do not follow me blindly, alright? The next trade to update is this new cash secure put on Nvidia, which I sold last Friday 7 November. The strike price is 150 and the contract will expire on 12 December. Once again, the reason for opening this trade is because Nvidia has been sold off quite a fair bit, though not as much as Meta. I mean, after 8 consecutive red candlesticks, it is only a matter of time before we see a short-term bounce. On top of that, my strike price sits right around the 200 moving average, which I believe should act as a strong support level. And honestly, if Nvidia does fall below 150 on expiration date, I wouldn't mind being assigned 100 shares at that price. When it was trading above 200, I'm quite sure plenty of investors said they wish they had bought earlier. So if it drops to 150, that's a great opportunity to pick up shares at almost 30% discount from its all-time high. Isn't that good? Here's the final trade to update, a cash secure put on Meta which expired last Friday 7 November. It has a strike price of 575 and the contract was sold on 3rd October when Meta was already in this downtrend. But just like what I shared earlier, the price can continue to fall, which it did, but so long as it doesn't plunge too sharply in a short span of time, my trades should still be profitable. And that's exactly what happened. Meta continued to fall after I sold the contract from 710s range to the current low 600s. It was a huge 100 points drop, but it still didn't breach my 575 strike price. And so the contract expired worthless last Friday, and the profit for this trade is around $285 US. Okay, sharing some of my thoughts of the current situation. With valuations in the tech and AI space still elevated, I'm sure many investors are watching closely to see whether the recent pullback was a temporary breather or the start of a deeper rotation out of growth stocks. Personally, I see this pullback in tech as a healthy correction after months of strong gains. After all, the Nasdaq has climbed nearly 50% from its April's low. The market was clearly looking for a reason to take a breather, and almost everyone was waiting for an excuse to sell. And so we saw that play out last week. Honestly, that's a good thing. Some air needs to come out of this so-called AI bubble. We need to deflate it a little bit. My take is that the sharp decline in tech stocks is a reason to stay cautious but not to panic. Many of these AI and tech names have been leading the rally, and typically the biggest winners usually take the hardest hit during a sell-off. In addition, I think the current pullback looks largely positioning driven, with traders taking profits in the riskier, high growth and outperforming names. Most importantly, there wasn't any major trigger behind the sell-off. It was just renewed concerns about stretched valuations, a weakening labour market, and the potential of an economic slowdown. The market has been brushing off this risk for months, from high interest rates to stubborn inflation and a shaky global outlook, leading to many asking if the AI boom is indeed a bubble waiting to burst. So I guess it's about time for the market to lock in some profits. All that said, a bit of risk coming off the table doesn't take away from what has been an incredible year, and so far the third quarter earnings have also held up quite well, with over 83% of the S&P 500 companies beating analyst expectations, according to LSEG data. Sure, there are growing doubts about the massive AI investments, whether they will translate to meaningful ROI or earnings growth, but it's not like any of these companies reported really bad results. It's just that some of them didn't fire on all cylinders, which what investors are demanding at this point and in this environment. As a result, some names have seen overreactions by the market, and one of them is Meta. And last week was the second consecutive week that I added to my Meta position. All in all, I just wanted to say, at these valuations and after such a strong run-up, it's natural for investors to get more cautious. I don't see that as a bad thing. It's just happening at a time when uncertainty around the economy is creeping in. There is nothing too worrying right now, but if something truly concerning does emerge, I will be here to talk about it. And as always, the real shocks are the ones not written in the current script. Okay, that's all I have for this video. If you like my content, do help me beat the YouTube algorithm by liking, subscribing and commenting something below. I will see you again in the next video. Thank you.